This is the World Financial Report podcast. My name is Randy Marshall. Joining us is our financial and diamond expert, Harold Siegel. We're taping on March 7th, 2019. Our time is 8:09 a.m. Mountain. Don't forget, this Saturday night, Sunday morning, time change, spring forward, fall back, clocks go ahead 1 hour. The following Sunday, we get to celebrate with St. Patrick's Day. Numbers this morning. U.S. dollar is at 97.29. It's up half a penny, plus 0.46. Canadian dollar, 74.51. A lot of that pullback has to do with the Bank of Canada not raising interest rates. The pound at 131, the euro at 112, gold at 1283.50, silver 1497, gold-silver ratio is 86. Platinum is 821, palladium 1511, WTI 56.59, Brent at 66.98, Nat gas 285, Bitcoin in US dollars $3,852.25, in Canadian $5,167.72. The Dow at 25,645, S&P at 2771, NASDAQ at 7,483, and the TSX at 16,092. As mentioned, Bank of Canada did not raise interest rates. No surprise there. More than likely, no further rate rises this year. The ECB did not raise rates this morning as well, said no raises in interest rates coming up in 2019. Evidence is growing that the trade war between the United States and China is doing real harm to the global economy. Some analysts warn that some of the damage could be permanent, effectively meaning any rebound from a deal would not lead to a full recovery. This suggests that having raised expectations on the likelihood of a breakthrough, U.S. President Trump may not get the stock market rally he wants from an official end to the standoff. He wants this to end very soon. Harold, it was 10 years ago this week. The market hit the climactic bottom of the Great Recession. The index has delivered a 10-year annualized total return of 17.8% since its financial crisis bottom in March of 2009, matching the annual gains 10 years after the 1987 crash and the August 1982 bottom. While the trailing 10-year return gets up to this area, it typically means a bull cycle is far along, but hasn't generally marked its end. Still, many professional and individual investors have been reluctant to embrace the 2019 comeback as gauged in sentiment surveys, fund flows, and hedge fund positioning. 10 years ago, the market bottomed. Interesting to note, Barack Obama got lucky. He was right. There was a press conference, and he said, well, maybe now would be a good time to buy. And it was right at the very bottom. I don't know if he invested or not, but if he did, he made some pretty good money. One thing we have to learn from this, though, Harold, is that only a certain amount of stocks have been leading the rally. If you weren't in an index fund where you had all the stocks of the index, there are many people that have missed out on this move because it's only been a few stocks that have been doing all the heavy lifting.
You bet they have. The fact is that if we remember, the Dow was at 14,000 in 2008, and it dropped all the way to 6,500 when the mortgage crisis, hit its full cycle type of thing. So, we saw a drop from 14,000 to 6,500, pretty well a 50% drop. Now, it's taken from 2009 when it bottomed out at 6,500 till now to hit 26,000. That's a 400% increase from low to high within that 10-year period of time. During that period of time, I'm sure there was tons of money made. But the fact is that a lot of it, was really done as a result of quantitative easing, of the government printing a huge amount of money, bailing out companies that would have gone under, insurance companies and banks. And if you remember at that point, Citibank, for example, dropped from $85 a share down to $5. Same with General Electric. And, McDonald's couldn't make payroll. And some of the biggest insurance companies were on the verge of going under. They had to bail out General Motors and Chrysler. And it was an unbelievable time. And if it wasn't at that particular time that they took the bull by the horns and really did what they did, which was, again, quantitative easing, printing all that money, bailing out those companies, the United States would look totally different than it is right now. In actual fact, I do remember, that the money market almost collapsed if they didn't actually raise if the FDIC didn't raise the insurance on individual bank accounts. I don't think we would be talking about the same United States right now. It would have been in even worse trouble. Now, even though they printed all that money, bailed out all those companies, and did all that, it's taken 10 years from the Dow to go from 6,500 to 26,500. It's really been stalled at this level in a range, for the last couple of years. So there's some troubles out there. There's no doubt that the market has made a big move, and there's no doubt, Randy, that you're correct in the fact that it was just a few stocks that really, moved the Dow up to that level. A lot of the stocks did come back. Disney, that was down to maybe, $15, is now back over 100, and there's several stocks that have come back, but very few have made those gigantic moves that Google made and Amazon made and Apple and all that type of thing. And then you saw what happened at the end of last year, at the end of the year, when the market, for those stocks fell by 30 to 40%. So these are not the same stock markets. The stock market is needed for retirement and that type of thing. People need a place to put their retirement funds so they can grow, so one day they can retire comfortably. Unfortunately, that isn't the case. The fact is that the stock market has really turned into a gambling casino. It's just so volatile and so risky, and at times manipulated depending on what the scenario and the situation is. It's just not the safe place to put your money. So a lot of people are not in the stock market anymore. It's the hedge funds that make up most of the trading in that market, and it's not the smaller investor at all, because smaller investor can't afford the market. They can't afford to buy Amazon or Apple or Google at the prices that they are, and there's just way too much risk in the market for that. So this market is a totally different market than it was 20 years ago. And the fact is that it's extremely risky for those that don't know what they're doing. All the markets are risky at this point here. Look at what happened in gold. I've always said that the major number that we have to watch out for in gold is 1380. Most people don't understand that. But the fact is I've been, certainly letting everybody know that 1380 on the upside in gold has got to be broken twice in a row in order for it to confirm a bull market, that the market's actually going to move higher. And every time we get close to that 1380 level, what happens? But the gold market backs off. It happened last year, I believe it was, when we got to 1370, and then the market pulled all the way back and made a gigantic downward move. So that's how important it is to make certain that if you are going to trade in these markets, that you know what you're doing, that you have some type of game plan and understand where the support and resistance levels are if you're going to make trades in these markets, especially short-term trades. If you're going to trade the futures market, my suggestion is, unless you're an expert trader, to stay away from that market. It's very heavily leveraged. It's extremely risky. 90% of the people that trade in those markets end up losing their money. So it's not something that I recommend for those that aren't well-versed in trading of futures and understand how the leveraged markets in futures can work for you and against you. So even options, where you may have a predetermined risk if you're buying calls, or if you're buying call options or even put options, the fact is, if you don't know what you're doing, you can still lose a lot of money. So my suggestion is that as we get to 1380, and again, there's been times I was tempted. There's certain situations in the market right now that could propel the price of gold above 1380. A lot of it have to do with the presidency, the fact that Trump could be in trouble. The fact is that he still could be in trouble over Russia. There's certainly situations out there that could throw him out of office. And if that was to happen, that is one scenario that I do believe could push gold over that 1380 level. But you saw how fast gold dropped from an intraday high of 1350 all the way down to 1280, and that's happened over the past couple weeks. So that's how quickly gold can retrace. Silver pulled back with it. as did other markets. So again, at this particular point, we have to wait until the market confirms its next move, and where we may get tempted to jump into a market based on the fact that it looks really good and the market could run and you want to pick up, those extra dollars. I still would recommend heavily against it, because this is 2 times now that we've come within, throws distance of breaking that 1380 level, only to see the market pull back substantially. In this particular case, it was a pullback of almost $60 to $70, and that is substantial in the price of gold.
Harold's website is rarecoloreddiamonds.com. Rarecoloreddiamonds.com. Speak with Harold and get the companion to the podcast, our free weekly newsletter. You'll see all the stories that Harold and I are taking a look at and the ones that we touch on during the podcast. Connect with Harold at rarecoloreddiamonds.com. The United States officially hit the debt ceiling as of Saturday, capping the national debt at just over $22 trillion. Congress suspended the debt ceiling for a year to February 2018 until now. So we're in a situation where there's going to be one heck of a battle between the Republicans and Democrats raising the debt ceiling. The U.S. budget deficit widened to $310 billion in the first 4 months of the fiscal year, underscoring the revenue hit from Republican tax cuts and an increase in government spending. The budget gap widened 77% compared with the same October to January period a year earlier, according to the Treasury monthly budget report. That was delayed because of the government shutdown. So you can see the United States, more than likely, they're in a situation where they have deficits of $1 trillion to $1.5 trillion a year. They're in debt to the tune of over $22 trillion. And now there will be at some point a fight over the debt ceiling and increasing that. Harold, they should be thankful that interest rates are not going up in the United States, because if they were, the pressure that would come from the interest payments they would have to make on all that debt would be substantial.
You better believe it. That would be a frightening thing. A $22 trillion debt ceiling at this particular point is just absolutely unbelievable. And how high do they think that they could raise that to? Because they're just not paying anything back. So that's quite concerning. And obviously the reason that Canada was concerned and didn't raise interest rates, in fact may drop interest rates, is primarily because of that reason. They can't pay or they don't want to pay, the interest on that debt at a higher rate. So it's a concerning situation. There's no doubt. The fact is that you can print money and borrow money. Both are going to affect your dollar in a big way. And again, that's one of the reasons that I believe that gold could take off again. And when it does take off, it's going to be a huge number. And that's primarily because the fact of the $22 trillion that is owed, plus, because they have to raise it. The U.S. can't stop doing business. It's going to be an issue. It's going to be a huge issue. And I don't know how in the world they're going to solve that issue.
There's a Harvard professor, Lawrence Klotnikoff, who says that the United States really owes $200 trillion when you factor in Medicare and other programs where the public is owed money. We know the Green Deal that Alexander Ocasio-Cortez is talking about. We mentioned it on the last podcast. That would add $93 trillion to the debt. Ex-Obama advisor Larry Summers rips dangerous economics backed by Ocasio-Cortez and other Democrats, including Bernie Sanders. Advocating the government print money without worry about the bills is a dangerous approach being pushed by far-left Democrats. Economist Larry Summers says, "I don't think this is a realistic calculus." And he really blasted Ocasio-Cortez and Bernie Sanders. Billionaire Sam Zell said Ocasio-Cortez-style wealth redistribution won't work. Americans don't want handouts. Everyone in the United States wants to be rich. Everyone in the world wants to succeed, in America as well. But adds, Americans want to earn success. Redistributive policy leads to inequity. It's just the opposite of what you think. think, says Zell. He says wealth disparities exist everywhere, but he believes the United States is one of the world's most equal economies. Thomas Sowell is warning about socialism, and he says the United States may not be able to resist the siren song of socialism. I wouldn't bet on it. Now, he's a living legend in the field of economics, and he fears the United States may eventually succumb to the siren song of socialism. Harold, I agree. I think there does seem to be a movement that is growing in the United States where people believe that they are owed something, and tax the rich, give me what I deserve, give me what I want. That is a recipe for disaster, in my opinion, but there does seem to be people that are actually wanting that in the United States.
Well, of course they are. And the fact is that now everybody wants to earn their success. But there's a lot of people out there, especially in the U.S. right now, that feel entitled, that thinks the government should be helping them, paying off their debts as far as college and things like that, and paying them what they need in order to survive. And the fact is that when somebody gives you a salary, they're paying you what they think that you're worth, as opposed to you going out and starting your own business or being a commissioned salesperson or whatever it is, where you get paid what you're actually worth because you're earning every bit of that money. So the fact is that the Democrats and these handouts are infuriating. The fact is that it will absolutely destroy the country. Look what it's done to Venezuela and other countries like that. So, the fact of taxing the rich, and that's not going to work to the extent that the wealthy are going to get so upset about this. The fact is that they're either going to leave the country, expatriate, which a lot of people have done, or it takes away the incentive to be successful. When you take the risk of starting your own business, putting up your own money, working the hours that an owner works, which at times can be ridiculous, the amount of hours that we put in to build our business type of thing. And then to think that we're going to be, when you take all that risk and you finally reach some level of success, and then that success is taken away from you because other people aren't willing to do what you're willing to do in order to be successful, but want a piece of your success, that just doesn't work. It just doesn't work. It's infuriating for people that, put in that effort to be successful, to take the risk to do better for their families. So I find it a slap in the face, to be honest with you. I find that if you don't want to work and you don't want to put in the effort, and the government does offer welfare or whatever, that's the way you should live, but you shouldn't live above that because you're not willing to put in what it takes to be successful. So when you get people like that Cortez, talking the way that she's talking, it's infuriating. There's people in the U.S. that just absolutely can't stand a person like her that wants to take everything that you've worked for and give it to people that just aren't willing to work. It just doesn't work in this country.
And as I said on the last podcast, more than likely, a lot of those people, they'll spend it, lose it, and then you're back to square one. What do you do then?
Like somebody winning a lottery, and they've done studies on this. When you don't know about money, when you haven't earned money on your own and dealt with it and worked with it and understand it, the fact is that most people that have won substantial lotteries end up broke because they don't know how to deal with money. So the fact is, when money is given to you, as opposed to earning it and understanding it, it's a totally different scenario. Most people think that if they won $100 million in the lottery, how phenomenal their life would be. But if you understand these studies that have gone, most people that have won that kind of money are broke within a year or 2 years later. So it doesn't work in that fashion.
One of the documentaries that I saw was there was a homeless man living under a train trestle, and he came into $100,000, and he ended up losing that $100,000 within a year, and he was back under the train trestle. So it's an unfortunate fact of life. Life is not fair. Dollar Tree is going to close up to 390 Family Dollar stores, reported $2.3 billion loss. The company took a $2.73 billion charge against its Family Dollar business during the fourth quarter. You know things are bad when dollar stores are struggling. struggling. Abercrombie is planning to close up to 40 stores in 2019. Abercrombie and Fitch is planning to close up to 40 stores during fiscal 2019. It's hard to believe, but many years ago, there was a company called Blockbuster. Maybe you remember it. You used to go there and you'd rent videos. There'd be a wall of videos there. And I had a friend, there'd be a wall of videos. There could be 99 superstar movies. He would find the one that was bad. He just had a knack for finding that bad movie. But Blockbuster, there's one store left in Bend, Oregon. The other location is shutting down in Australia. I wonder if these people who still go have heard of Netflix and Amazon Prime. I'm sure they have, Harold, but it's amazing to me that there's still one Blockbuster store alive and well in Bend, Oregon. We'll see how long that lasts. When was the last time you went to a Blockbuster? I can't even remember.
No, me neither. And that was the good old days when Wayne Huizinga, the owner of the Dolphins and the Marlins and a big man here in South Florida, actually owned that company. So you're right. That brings back memories, Randy. It's a long time.
Connect with Harold at rarecoloreddiamonds.com. rarecoloreddiamonds.com. Speak with him about investing in hard assets. Get our free weekly newsletter, the companion to the podcast. Mark Zuckerberg had a rough 2018. Facebook was plagued by scandal and data breaches, and Zuckerberg's wealth shrank along with his company's fortunes. The Facebook CEO, his net worth fell by $9 billion. They released the Forbes list of the top billionaires. President DT, Donald Trump, he rose 51 spots on the Forbes billionaires list. His net worth stayed at $3.1 billion. At the top of the list, Jeff Bezos of Amazon. His wealth rose $19 billion in 2018 to $131 billion. He's in first. Microsoft co-founder Bill Gates landed in second place. He is at $96.5 billion from $90 billion the year before. And in third place, Warren Buffett. Buffett slipped $1.5 billion to $82.5 billion. Warren Buffett, Bill Gates, they plan on giving away all their money to the Gates Foundation to help out those less fortunate around the world. Jeff Bezos, Harold, he's making a donation to what they call the divorce fund. 50% is going to be going to his wife, soon to be ex-wife, because they're in the process of getting divorced. But people, as Harold always says, there's always somebody out there making money. There you go. Jeff Bezos, the richest man in the world.
Not anymore. 60 trillion of it is going to his wife. So that's a big number, man. That's a big number. And I wonder if those numbers reflected the drop that we saw in Amazon stock that dropped, close to 40%. So I'm surprised that his net worth went up that much with the pullback that we saw around the end of the year.
There was somebody that was added to the list, $1.5 billion Mega Millions jackpot winner in South Carolina. They allow people to win without releasing their name, which I think is a very good idea. It should be done here in Canada. Christie's plans to offer the 1964 work Buffalo 2 at a May 15 auction in New York City with an estimate of $50 million. That's almost triple the late artist's auction record and 300,000% more than what the original buyers paid for the collage-like canvas, which depicts President John F. Kennedy and was completed shortly after his assassination. But that is coming up for sale. There's a Bugatti. The most expensive car in the world is going to be sold for the 110th anniversary of Bugatti, $12.5 million. When you add in all the taxes, they're saying it's going to be around $19 million. Scotch whiskey revealed to be the best 10-year investment with a whopping 582% return. Whiskey has been named one of the most lucrative items of the decade in a wealth report on valuable investments. Rare Scotch topped investor Knight Frank's luxury index after reporting 40% annual growth, outstripping cars, watches, and even diamonds. It's the first time the report has included the Rare Whiskey 100 Index as a list of the world's 100 most valuable bottles. We have a list here, Harold, of the most valuable investments in the past decade, and we'll go through them just very quickly. Number one, art, Portrait of an Artist pool with two figures by David Hockney. That was sold for $90 million. Whiskey, a bottle of Macallan 1962, hand-painted by Michael Dillon, sold at Christie's for $1.5 million. Jewelry, the Marie Antoinette pearl pendant, sold by Sotheby's for $36 million. A watch, 1970 Rolex Daytona Unicorn, sold by Phillips with Bax and Russo for $5.9 million. Classic cars, 1962 Ferrari 250 GTO, sold by RM Sotheby's for $48.4 million. Wine, a bottle of 1945 Romani Conti, sold by Sotheby's for $558,000. Stamps, a 1918 Jenny Invert 24 cent, sold by Robert A. Siegel Auctions for $1.6 million. Coins, a 1621 Polish Gold 100 ducat, sold by the Classic Numismatic Group for $2.2 million. On the colored diamond side of things, which we're very interested in, obviously, the Winston Pink Legacy 19-karat fancy vivid pink diamond, sold by Christie's for $50 million. And finally, furniture, a 1766 Chippendale commode with ivory inlays, sold in 1991 for, and this is in British pounds, $935,000, a record for a piece of English furniture. Harold, who would have guessed? I would have thought maybe wine would be up there, but Scotch whiskey is getting to be a very hot collectible.
Unbelievable. I mean, I'm very familiar with wine and know how much they've gone up in value, but let's face it, there are some whiskeys that are very expensive, and obviously that is one of them. It just goes to show you that hard assets, over the longer term, hold their value very well. Don't trade on exchanges so you don't get the volatility that you get in commodity or stock markets. And the fact is that the longer you hold on to these rare pieces, the more and more they're worth. So again, it's great to see those type of returns and to see that something like whiskey could have gone up almost 600% over that 10-year period.
Last week, we had the Oscars, and in our free weekly newsletter that you can get from Harold, connect with him at rarecoloreddiamonds.com, we had an article on the Tiffany diamond that Lady Gaga wore to the Oscars. Only the third woman to wear the Tiffany diamond, which is a stunning yellow diamond worth $30 million. We have another story about the Tiffany diamond. You can read that in our free weekly newsletter. There's a picture that they have of Audrey Hepburn, who wore the diamond for breakfast at Tiffany's, and Lady Gaga side by side. But who knows when the next time will be that it will be brought out and someone will be allowed to wear it. I would imagine it could be a long time.
I would certainly say so. Again, you don't want to bring a diamond like that out too often because it makes it too familiar to the market. And one day they're going to want to sell that diamond. And again, you don't want it to be something that, that everybody has seen type of thing. In diamonds, the more rare the diamond is, the more expensive it is type of thing. So that's why they've only shown it so few times, 3 times in total. I know that when I was being interviewed on Fox News and I had Elizabeth Taylor's 100-carat D flawless necklace and 22-carat earrings with me and let Deidre Bolton wear it, that was definitely the highlight of her career. I mean, to wear that Tiffany, or to wear in that case, Elizabeth Taylor's diamond necklace and earrings, is just something that most women would just absolutely love to do. And that was the case with Lady Gaga, and it was the case with Deidre Bolton when she got to try on Elizabeth Taylor's necklace. It's a real treat.
When Harold was on Bloomberg and then on Fox, both interviewers were very excited to take a look at the diamonds that Harold had. Side note, in 1972, Tiffany placed possibly tongue-in-cheek ad in the New York Times offering the diamond for $5 million, about $25 million today. Somebody should have taken them up on it, called their bluff. And they said, though, that the money had to be in within 24 hours. Any checks mailed after the date would be returned with thanks. In 2012, the diamond was set in its current diamond necklace setting for Tiffany's 175th anniversary. Harold, we are at the end of our podcast. Any closing thoughts?
Yeah, again, just be very, very careful when you're trading these markets. Again, everybody wants to make money, and it'd be nice to be able to catch a trend at the bottom and run it all the way to the top, as we did with gold back in 2000 all the way up to 2011. But don't forget, it's been 8 years now since gold made that monumental run to 1920, and since that time has traded in a range between 1,050 and $1,370. It's never gotten above that 1380 level again. So be very, very careful. The only time you want to be involved short term in trading gold is if it breaks 1380. If it doesn't break that price and close twice above it, the chances are that market's going to pull back. So please be very, very careful. If you need any advice or help trading these markets, you certainly know how to contact me. I'm not selling you gold, and I'm not selling you anything at this point. I'm giving you information as to if, for those that want to trade gold or buy gold, again, I think the gold is a great buy at these levels, and I do think that over the longer term, even the intermediate term, that the market's going to go substantially higher with some of the situations out there. But until it breaks that 1380 level, don't get fooled and don't buy heavily into leveraged gold, because the chances are you won't do well. I want to wish everybody a wonderful weekend and a very profitable day.
Closing, we heard the news yesterday that Jeopardy host Canadian from Sudbury, Alex Trebek, has stage 4 pancreatic cancer. I watched the little video that he made. He was quite funny in a very tough situation, saying that he needed to continue on because his contract was going to be up in a few years and he needed to fulfill it. Harold, we wish Alex Trebek all the best.
You bet. Always loved Alex. Great representative of Canada, always did a great job, and I'm very sorry to hear that he's going through this.
All the best to Alex Trebek. Speak with Harold at rarecoloreddiamonds.com. Rarecoloreddiamonds.com. We believe there's an opportunity in rare pink diamonds from the Argyle mine. You can ask Harold about that. That's it. Another edition of the World Financial Report podcast. For Harold Siegel, my name is Randy Marshall. We will talk to you next week.